what are the 3 things that will ruin your pre-approval? Or like make you unqualifiable for a mortgage?
Well, listen, if you come to me and you have a 400 credit score, we got some work to do, right? So credit is number one.
What is the lowest credit score you can have?
Depending on the down payment, if you have a really strong down payment, I could do 550.
Okay.
All right. But most of the time, if you have a 550 credit score, there's another reason why we can't get the loan to qualify, right? Like you have a massive amount of lates within the last 12 months, right? And the systems are just going to look at it, and the underwriter is going to look at it and just be like, we can't qualify this loan because of X, Y, and Z reason.
What about if you have bad credit because you have no credit?
Well, that's an easy fix, right? We can add you to an authorized user account. We can get you some prepaid credit cards. Your credit score is going to pop in 60 to 90 days, right? And you automatically get yourself into something.
Is that all you're looking for, a credit score, or are you looking at credit history?
No, score and history. Right.
Okay.
So we're going to look at everything. There's major derogatories, like if you had a foreclosure or bankruptcy, there's waiting periods for that. If you did a short sale, there's a waiting period for that. If you're a first-time home buyer, technically you wouldn't have that stuff because
you wouldn't foreclose on a house you didn't have.
Correct. But
But bankruptcy, you can have bankruptcy within how long ago? 5 years, 7 years? What is that?
No. So conventional, you could go bankrupt 4
years.
4 years. FHA is 2 years.
Wow.
2 years.
2 years from discharge date.
Wow, rebound real fast.
Yeah.
So then what about, because I actually get asked this a lot too, because I think right now credit card debt is heavy.
It's very heavy.
So
highest it's ever been.
I always get asked by buyers, what if I have a 30-day late or a 60-day late? How is that going to affect me?
It's going to negatively affect your score, but a 30 or 60-day late in the last 12 months isn't going to be a major issue for qualifying for a loan, right? You're going to end up in an FHA loan because your credit score is probably going to be in the mid-600s. So unless you're putting a large sum of money down, it's going to be more advantageous to go FHA. But you should still be able to qualify with that stuff.
What are credit scores to get into a conventional? What do they start at?
It depends on the down payment. I would say that 680 is going to be your absolute minimum if I'm looking at a conventional loan. Let's say 10% down. If you're putting 20% down, that number can go all the way down to 620 as long as I get it through automated underwriting, because you may be able to get a lower APR, which is the actual overall cost of the money on a conventional loan versus an FHA. And I'll go into that nitty gritty of what an APR is during a buyer's consultation because it's very complex.
Yeah. So let's say the person got pre-approved. Hooray, right? Mm-hmm. What should they not do to ruin that pre-approval?
So you're pre-approved and you're shopping for a house. Don't co-sign on anybody's loans. Don't go late on anything. Don't open up any new debt, right? Don't get fired from your job, right? Don't
get fired.
Don't go from W-2 to 1099, right? I've had clients that said, "Hey, I got an opportunity to go from $100,000 W-2 to $100,000 1099." No. Not in the middle of the process, because at 1099, you're either an independent contractor or you could be self-employed. So then we would need a minimum of 1 year tax return, and you're not going to file that tax return. So if you earn a 1099 all the way through 2026, you're not filing that tax return till March, April of 2027?
And then you also have to worry about your write-offs, correct?
Correct. So if you start at 100,000 and then you write it all off, and then the bottom, your adjusted gross income, let's say, is 30,000. Now that 30,000, there's some things I can add back, but that 30,000 is now the qualifying income.
Mm-hmm. And if you are self-employed, right, can you still buy a house?
Oh, absolutely.
It depends on the taxes, though.
Correct.
Don't deduct everything.
Well, there's certain deductions that you can take that are just accounting deductions. They're not actual cash flow deductions. So depreciation, depletion, that's an add back. So say, for instance,
what about for realtors, we deduct miles?
Well, there's a percentage of the miles that is going to be a depreciation factor that we can add back.
So you can adjust the income that's on your tax return to reflect the more or less real income
that is correct.
So from the lending side, what is the biggest reason that deals fall apart? Because we know on the real estate side, it's
home inspection. Home inspection. It's the same for us. I would say that home inspections kill more deals in my pipeline than anything else.
But what makes you give pre-approval, but then at the end say, I'm sorry, this person does not qualify, we cannot give them the loan?
Well, something would have to happen, right? So I do a lot of diligence up front, and sometimes clients get a little upset because I'm asking for documents. And I'm like, listen, the reason why I'm doing that is because I want to make sure that when you hit the road and you're looking at a house, that you can actually close on said house.
Yeah.
When deals fall apart, it's because, number one, overtime dries up, right? So they were doing a tremendous amount of overtime in, let's say, 2025, and then they start shopping for a house in January of 26, and they don't find that house until April or May of 2026, and then all of a sudden they have no overtime for 2026. Makes it very hard to use that variable income to qualify the loan. That job loss, and
it's just something that would happen in between your pre-approval and closing typically.
Correct. And the other thing is this. If somebody's giving you, like sitting with you and telling you, please don't open up a new trade line, please don't do these things, it's because it's going to negatively affect you, right? If you're looking to buy a house and you think it's more important to buy a new car before you buy the house,
buy that car before getting pre-approval.
It's always the car, by the way.
It's always a car.
Everyone, there's a lease that needs to switch over.
100%.
There is one thing that kills all the deals.
100%.
A new car.
It's the new car. Everybody sees the new model come out and they need it. They got to have it. And I try to tell them, automobiles is an appreciating asset and a home is an appreciating asset. I need you to make a sound financial decision on this. Okay?
So Dan, as the lender with such long experience, what is one advice that you would give any first-time home buyer?
Thank you for calling me old.
I didn't.
No, she said experience.
I said experience. That's not old. Experienced.
You can be young and experienced.
One piece of advice that I can give to a first-time home buyer is that if you want to buy a house, do it, right? If you hold a house long enough, you're not going to lose money on it. If you can stay there for a long period of time, you're always going to make money on it. And you're hedging against inflation, right? And as the government prints more and more money, assets become more and more expensive, rents are going to go up. If you can fix your money, meaning that principal and interest payment on that mortgage is not going to change for 30 years, that means that you're getting that house for today's dollars, and 10 years from now, those dollars will be worth way less.
Yeah. Tell us how you bought your first home.
I bought my first house with an FHA loan, 3.5% down. It was a house that my wife told me that if I bought, she wasn't moving in with me.
And then she did.
She did. The house smelled terrible. Smelled like cat urine. The whole place there was a hump in the middle of the floor. I needed to shave the beams. There was a lot of work that needed to be done.
But as FHA, was it approved as FHA?
It was approved as FHA because there was no exposed wiring, no broken windows, no peeling paint, nothing like that.
Oh, here is the question too. If the house needs repairs, can it be the first-time home buyer who's buying it? Will it be approved for the loan of a first-time home buyer, like FHA or conventional 3%?
Sure. So if you're a first-time home buyer, you can buy a house that needs a little bit of renovation to it. It just has to be habitable, right? It can't the caveats for FHA are peeling paint, broken windows, exposed wiring, missing handrails, rotten wood, stuff like that.
They're looking for more safety concerns.
Correct. I mean, you want to buy grandma's house? It's got a 1970s GE stove in it, and it still works. By all means, buy it. I'd actually prefer you bought that house instead of the fully renovated house because ultimately, if you buy the fully renovated house, you're limiting the amount that you can actually put into it from a sweat equity perspective. And as younger people, the way you can increase the equity in your house or the value in your house is do it yourself, right? Yeah. Some of the things you can just do yourself.
Yep. Especially if you're young, you have all the energy.
Correct.
So what about, let's talk a little about rental loans then.
Sure.
Conventional home style or 203K?
Depends. How much renovation do you need? What's the purchase price? So on a home style renovation loan, you can only use 50% of the purchase price as a renovation budget. So if you found a house for $100,000 and needs $100,000 worth of reno, you can't do a home style renovation loan on that.
How much you can?
50%. Yep, 50% of the house's value at purchase price.
And are the interest rates on those loans higher than your standard loans?
Yeah, interest rates on renovation loans are usually about 1/4 to a 1/2 point higher, depending on your credit profile.
Is it harder to qualify?
it's not harder to qualify from a ratio or credit standpoint. It's harder to qualify because you need more money to close because you've got increased closing costs, and because of the higher rate, it's going to push up your ratios a little bit. But ultimately, you should be buying that property for well below market value.
So then you can refinance.
Correct.
So how does appraisal work with that? How do they factor if the house is worth it?
So if it's a renovation loan, they're going to look at the future value of the home. So one of the steps within a renovation loan is called a consultant. We have a HUD consultant that will go out to the property and they will draw up a report called a specification of repair. And that specification of repair will be given to the appraiser. So the appraiser can then look at the current residence and say, okay, this is what's going to be done, and give it a future value.
So we heard a lot of useful information from Dan, and if you still have a couple questions, reach out to us. I will leave the links below, but also I highly recommend to sign up for buyer's consultation. It's free, no obligation. Come, talk, ask all the questions, and we will be so happy to help you with getting pre-approved and then also show you houses that you can afford.
Absolutely.
Yeah.
We're more teachers than anything else.
Yeah. Education, number one. That's it. You see, this was easy.